In the months before the 2008 financial system collapsed, a small group of hedge fund managers placed billions of dollars in bets that the housing market would implode. They didn't just predict the crisis, they engineered positions that would only pay off if millions of families lost their homes and the global economy entered freefall. What separates a calculated bet from deliberate sabotage? And when does profiting from disaster cross the line into causing it? The 2008 financial crisis resulted in nearly 9 million Americans losing their jobs, 8 million losing their homes to foreclosure, and global economic output dropping by an estimated $2 trillion. The foundation was laid in the late 1990s, when Congress repealed the Glass-Steagall Act, which had separated commercial banking from investment banking since the Great Depression. This allowed institutions to use customer deposits to make risky bets, concentrating financial power and interconnected risk in ways that would prove catastrophic. The change was championed by financial industry lobbyists, who argued that modern markets required flexibility and that regulations were outdated obstacles to growth. Between 2000 and 2006, mortgage lending transformed. Banks originated loans, immediately sold them to investment banks, who packaged them into complex securities, which were then sold to investors worldwide. This originate-to-distribute model severed the connection between lending and risk. By 2005, a handful of traders began noticing warning signs that something was deeply wrong. Greg Lippmann, a trader at Deutsche Bank, started dissecting the complex mortgage-backed securities flowing through the system. As he dug deeper, he realized that the underlying loans were catastrophically flawed, their collapse inevitable. Recognizing the opportunity hidden within the disaster, Lippmann began pitching hedge funds on instruments called credit default swaps. Essentially, these were insurance policies on financial collapse, bets that thrived on catastrophe. If you knew a building was structurally unsound, would you buy insurance on it or warn the people inside? In 2006 and 2007, Goldman Sachs executives described their own mortgage products as junk, while continuing to sell them to clients. One email revealed executives were focused on getting closer to home by reducing their own exposure, while maintaining public confidence. The firm began building massive short positions, betting against the very securities they marketed as safe. Internal emails exposed a culture of knowing deception where profits were prioritized over honesty or ethics. This deliberate strategy of selling unsafe products while betting against them became emblematic of Wall Street's moral hazard. Clients trusted the ratings and assurances, unaware that the people selling the securities were simultaneously positioning to profit from their failure. In 2007, as mortgage defaults began accelerating, Citigroup and Merrill Lynch continued selling risky mortgage securities. Their own risk departments had repeatedly warned that the underlying loans were dangerously flawed. This contrast between internal warnings and outward sales highlights a perverse incentive system. Traders and executives were rewarded for short-term revenue, while long-term consequences were ignored. By the time mortgage securities began to fail, their profits were already secured, leaving clients and the public exposed. This pattern of exploiting a failing system, while claiming safety to the outside world, became a defining feature of Wall Street's pre-crisis culture. Shocking the financial world, the Federal Reserve stepped in, arranging a sale to J.P. Morgan Chase for a fraction of Bear Stearns' former value. Throughout the summer of 2008, Lehman Brothers executives held frantic emergency meetings, desperately seeking buyers or government support. Internally, documents revealed executives knew the firm was insolvent. Weeks before announcing bankruptcy, on September 15, 2008, Lehman Brothers filed for bankruptcy, triggering a global financial domino effect. Within weeks, AIG required an $85 billion bailout. Washington Mutual collapsed, and credit markets froze as trust between institutions evaporated. The world watched as the American financial system teetered on the edge, millions of livelihoods hanging in the balance. In October 2008, the U.S. government launched the Troubled Asset Relief Program, injecting $700 billion into the financial system. The Federal Reserve slashed interest rates to near zero and began buying securities to stabilize markets. These actions prevented total collapse, but guaranteed that reckless institutions received public funds while ordinary Americans suffered. Wall Street bonuses were still paid, highlighting the stark imbalance between those who caused the crisis and those who bore its consequences. The public watched as billions were funneled into institutions deemed too big to fail. While unemployment and foreclosures skyrocketed, the government's emergency measures stabilized markets, but they left deep scars on public trust and the perception of fairness. Internal communications and congressional investigations revealed that banks knowingly sold defective mortgage products while betting against them. Goldman Sachs Abacus deal shows clear evidence of structuring a product to fail for profit. Hedge fund manager John Paulson selected the riskiest mortgages, believing they would collapse. Investors who purchased the Abacus CDO were not informed of Paulson's role or his short position. The Securities and Exchange Commission filed a civil complaint, and Goldman settled for $550 million without admitting wrongdoing. Emails and internal memos from multiple banks show conscious awareness that the products were unsound. Whistleblowers testified that rating agencies were pressured to assign high ratings to securities they knew were risky. These actions created a system where profits were privatized and losses were socialized. Some defenders of Wall Street argue that the crisis was caused by complex factors, not deliberate malice. Former Treasury Secretary Henry Paulson claimed that most participants acted on flawed models in genuine belief in rising housing prices. Some argue that short positions by firms like Goldman Sachs were prudent risk management, not predatory behavior. Economists like John Taylor point to government housing policy as a root cause, creating moral hazard. Historical studies show that irrational exuberance and herd behavior have repeatedly caused financial bubbles and crashes. However, these perspectives do not fully explain the deliberate deception documented in internal communications. The largest gap in accountability is the absence of individual prosecutions. Despite extensive evidence of wrongdoing, this gap fuels ongoing debate about whether justice was truly served after the crisis. For millions of families, the crash meant catastrophic personal loss far beyond finances. People who had worked decades to build equity watched homes enter foreclosure, destroying credit and forcing families into rental markets. The psychological toll included increased rates of depression and anxiety, substance abuse, and suicide among those who lost homes and savings. Communities, particularly communities of color, experienced disproportionate harm. Predatory lending had deliberately targeted Black and Latino neighborhoods, even for borrowers who qualified for prime mortgages. When the crash came, these communities saw steeper foreclosure rates and slower recovery, widening wealth gaps. Entire neighborhoods in cities like Detroit, Cleveland, and parts of California became abandoned zones where property values collapsed. The impact rippled globally, affecting European banks and workers in countries far from Wall Street. The crash demonstrated how interconnected modern finance had become, and how recklessness concentrated in one sector could metastasize worldwide. Economist Simon Johnson, former chief economist at the IMF, described what happened as institutional corruption. The financial sector grew so powerful and politically connected that it effectively captured the regulatory apparatus meant to constrain it. Think of it like hiring foxes to guard the henhouse, then acting surprised when chickens disappear. The system wasn't designed to prevent crisis. It was designed to allow profitable risk-taking with public bailouts as insurance. The concept of moral hazard became terrifyingly real. Financial institutions understood they were too big to fail, meaning government would rescue them rather than allow systemic collapse. This implicit guarantee removed normal market discipline. If your bets pay off, you keep the profits. If they fail catastrophically, taxpayers absorb the losses. Legal scholar William Black argues the 2008 crisis involved control, fraud, where executives used their own institutions as weapons to generate profits through fraud. When CEOs received bonuses for loan volume regardless of quality, and new loans would be sold before defaulting, the incentive was to maximize bad loans, Multiply this across the industry, and individual rational actions produced collective catastrophe. Here's what documentation proves. Major financial institutions knowingly sold defective products while betting against them. Executives received internal warnings they ignored, and regulatory capture prevented intervention that might have limited damage. What remains debated is whether this constitutes planning a crash versus exploiting a situation they recognized but didn't create. The question isn't whether individual actors behaved badly, but whether the system itself is designed to allow, even encourage, such behavior. Regulatory reforms continue eroding. Without sustained political will, protective measures will likely continue deteriorating. Similar patterns are emerging in cryptocurrency markets, private equity, and climate-related financial instruments. Continued lack of individual accountability means future misconduct will likely follow the same pattern. Settlements without admission of wrongdoing, no executive consequences, and public absorption of costs. Financial crises follow predictable patterns, partly because each generation forgets the lessons of the previous one. As people who experienced 2008 age out of decision-making positions, the same mistakes become more likely. The 2008 financial crisis wasn't a conspiracy, but a predictable result of a system prioritizing personal profit over collective consequences. Until incentives change, until those who profit from instability also bear the costs. The question isn't if another crash will happen, but when and how. Follow for more hidden history and real true stories. Like and subscribe Prime Vault Stories, and click the bell icon.